Now, when most folks thinking about investing, they thinking about one thing, returns. But there's another side to investing that hardly nobody talking about, risk. And here's the thing about risk, it's even more important than returns. By the end of this video, you'll know why and what you can do about it. Good day to you folks, Money Jim here, your money pal. For plenty folks, risk sure is one scary word when it comes to money. Might sound like gambling or losing your hard-earned dough, but in fact it's the opposite. See, when it comes to investing, risk is about how much we're gonna take. Having that level of risk under control so you ain't taking too much, and just as important, you ain't taking too little neither. What in tarnation actually is risk? Well, some see it as volatility, or in plain English, your investments going up and down. Others see it as the possibility of losing money. However you see it, risk is the chance of something going wrong with your investments. Now, when you invest, plenty times along the way, your investments won't do what you hoped they would. So the level of risk is how much going wrong you're prepared to take. It'd be easy just to say, I am willing for nothing to go wrong. I don't want to take no risk at all. Then you have to play it so safe, you wouldn't hardly make any money at all. As the old saying goes, no risk, no reward. If you want decent returns, you gotta accept risk. That's why most investors get more than folks who keep their cash in the bank, because they willing to take some risk. But it ain't all or nothing. You don't have to dial that level of risk up to the max. You can just take a little, or somewhere in the middle, or high but still not gung-ho. And you can have different pots of money at different levels of risk if you want. Some low, some high, and some in between. It's all up to you. You in control. Some folks might think they in control of the returns they're gonna get, but they living in cloud cuckoo land. That's because most of the time, the returns you get in general, whatever the market's giving you. And you ain't got no control over markets. No one does. And much as plenty like to guess, no one knows for sure where they headed next neither. But like I said, you can control your level of risk. Let me ask you this, Sunshine. What should you focus more on? Something you can control or something you can't? That's right. And that's why you're gonna pay more attention to risk. Think of it a bit like this. Your returns are a wooden cart. And that wooden cart ain't going nowhere without no horse pulling it. But it's up to you what kind of horse or your level of risk you got up front. You can have a tame old mare pulling you all nice and slow, and she'll get you there one piece all right, but it's gonna take some time. Or you can have a wild young stallion. He'll get you there much faster, but you know you're in for one wild ride along the way, if you even make it there at all. You know what I'm saying, Sunshine? Good. But I know what you're thinking. How'd you actually switch up or down that level of risk? What does high risk or low risk actually look like? Well, risk comes in plenty of shapes and sizes, but here's some of the main ones. First off is the type of investments you pick. See, some are naturally higher risk than others, like stocks, crypto, and commodities. And that's where you got the potential. And I said potential for higher returns, while others tend to be less risky, like bonds and other stuff paying you steady income. In fact, most of your long-term returns are down to your asset allocation, or in other words, how much you got invested in stocks versus bonds versus whatever else you invested in. Some smart folks say as much as 90% of your returns are down to this. So the most important thing ain't which stocks to pick, but how much to invest in stocks in the first place. Now that begs the question, how much should I invest in all the different types of investments? Well, I can't answer that for you now, sunshine, and neither can nobody on YouTube or TikTok or whatever, because that's real personal to you. See, it depends on a whole lot of things like how long you invest them for, how much growth you need to reach your money goals, what impact a drop in your investments will have on your lifestyle, how much risk can you stomach, and so on. Now, Jim here can help you figure this out for yourself in my other videos, but if you're really unsure and you want someone to do it for you, make sure whoever it is knows about you and your situation. Don't go listen to nobody on social media who don't know a thing about you, you hear? Otherwise you could be asking for trouble. Folks telling you to go invest in this or don't invest in that, they ain't thinking about what's right for you at all. And like I said, they probably ain't thinking about risk neither. Sure, they can get away with it for a while, but sooner or later, if you ain't been paying no attention to risk, it's gonna jump up and bite you real hard in the behind.
Yummy yum.
Another important way to control risk is how many investments you got. You might have heard of diversification. That's spreading your investments around so you ain't putting all your eggs in one basket. See, even if you invest in all-in stocks, for example, if you just own a handful of them, you ramping up that risk even farther. Sure, you got a chance of making some big bucks if they come good, but even if one goes pop, it's gonna put a real big dent in your returns. Same goes for which sectors you invest in. Sure is a risky thing to go all in one area, whether that's tech, healthcare, or whatever. The simplest way to spread your risk around is to invest in an index tracker fund or ETF that invests in every company out there. So by default, you got investments in all the different industries too. Now the last thing I'm going to talk about that can change your level of risk is old father time. See, the longer you invest, the less risky it is. While investing for just a short amount of time is risky because there ain't so long to recover if things drop. Some folks, 1 year seems like a long time, but investing, that's a blink of an eye. If you invest in something high risk like stocks, ideally you want to invest for at least 5 years, bare minimum. Anything less than that, you run the risk of a big drop without enough time to recover. So for example, if you buy a property in a couple years, don't stick your down payment on stocks. Sure, you could grow it, but Murphy's Law says when the time comes to buy, markets are down and you find your down payment ain't enough no more. If you need the money in less than 5 years, probably want to stick to lower risk stuff like high interest savings. Getting a level of risk that's right for you is probably the most important thing you can do in investing. Yet most of the time, plenty of folks pay no attention to this whatsoever. They just chasing what they reckon are gonna be the best returns. The irony is, it's risk that has arguably more of an impact on those returns than anything else. Your level of risk should be high enough for your long-term money goals, but not so high that it's keeping you awake at night or making you trigger happy on that sell button every time there's a drop. Might sound like an obvious thing to say, but we ain't all the same. Your stomach for investing, or how long you're investing for, or how much growth you actually need is different from everybody else's. So you've got to work out what level of risk is right for you. Now, if you don't know or want some help, my next video's for you, sunshine. See you next time.